What if you could retire and not just survive comfortably, but actually let your savings quietly grow, adapt to inflation, and give you consistent income for years to come without living in fear of market turbulence? Imagine your nest egg not locked under a mattress, but working for you, protecting your capital, generating income, and preserving your purchasing power even decades into the future. As you transition into retirement, the instinct may be to avoid anything that feels risky. But overallocating to cash or ultras, a fixed income may seem conservative and yet quietly destroy your wealth's real value over time. Inflation silently erodes buying power, rising costs, healthcare, and decades of living can eat into principal. The smarter way is not to hide from risk, but to manage it intelligently. That means building a diversified portfolio. Keep a foundation of fixed income, short-term or high-quality bonds, or certificates of deposit CDS, which offer stability and predictable income. But also set aside a portion for assets that offer growth and income together, high-quality dividend, paying equities, or equities with histories of dividend growth. These companies tend to belong to essential industries, healthcare, consumer staples, utilities resilient in both booming and shaky economies. Their dividends, often rising over time, help offset inflation. You can add another layer through assets tied to real value, real estate exposure via real estate investment, trusts, rates, or real assets. Rates can deliver consistent dividend, like income, often with the added benefit of rents and property values rising over time, a natural buffer against inflation and rising cost of living. In effect, it's like holding property without the hassle of maintenance, but still capturing real-world value growth. A smart retiree doesn't rely on a single safe bucket. Instead, your portfolio becomes a resilient engine, some capital preserved in safe, low-volatility instruments, some invested in income-generating and growing equities, some in real assets or inflation, hedging holdings. Add to that a cash or liquid reserve for unexpected needs. But building this philosophical and financial structure isn't enough. You must remain active, review and rebalance periodically. As some assets appreciate while others lag, the balance can shift, potentially upsetting the risk/return profile you need. A disciplined rebalancing, shifting gains from overweighted portions into underweighted ones, helps keep your long-term plan intact. Over decades, as costs rise, inflation fluctuates, and personal needs evolve, this combination stability, income growth, diversification becomes your shield and engine. It's not about chasing high returns or risky speculations, but about steadiness, flexibility, and respect for time. Retirement shouldn't signal an end to growth. It should mark the transformation of savings into a self-sustaining balance sheet that adapts and endures. By blending fixed income, dividend, bearing equities, real assets or real estate, linked instruments, and smart liquidity while remaining vigilant and adaptive, you give yourself a chance not just to maintain wealth, but to grow real purchasing power and enjoy financial dignity for as long as you live. What if I told you that 2025 offers more than just safe choices for retirees? It offers intelligent, strategic investments that can both protect your nest egg and keep it alive, growing, responsive to inflation, and ready to support you for decades. Because in today's world, playing it safe doesn't mean hiding. It means being thoughtful, diversified, adaptive, and giving your money the chance to work for you, even in retirement. Many retirees instinctively shift almost everything into ultras, AIF assets, cash, CDs, plain bonds, thinking they're minimizing risk. But that instinct often carries a hidden risk: lack of growth, exposure to inflation, and the danger of outliving your savings. A recent study found that a majority of retirees who overconcentrate on cash or bonds fail a basic diversification test. They leave themselves vulnerable to inflation or long-term financial erosion. Investopedia +1 Smart Retirement Investing in 2025 isn't about swinging for the moon. It's about building a balanced, resilient portfolio, one that offers income, stability, and growth. One effective foundation is fixed income instruments, things like short duration or high quality bonds, or even insured certificates of deposit CDS. These provide predictable returns, low volatility, and, if used as part of a broader plan, serve as the bedrock that guards against market shocks. Smart Asset Plus 2 Smart Financial Media Group, LLC Plus 2, but that safe layer shouldn't be your entire fortress. To stay ahead of rising costs, inflation, and the unpredictability of decades ahead, a portion of your portfolio should aim for growth without reckless risk. Dividend paying stocks from stable, financially sound companies remain among the most effective tools. These firms, often in resilient sectors like utilities, healthcare, or consumer staples, tend to weather economic cycles better. Their dividend payouts offer income, and well-chosen stocks can preserve and even grow real purchasing power over time. Senior Site Plus 2, the Motley Fool Plus 2, adding another dimension. Income-generating real assets via real estate investment trusts rates. Rates let you effectively own real estate, residential, commercial, infrastructure without the headache of managing properties. They tend to produce steady dividends because by law many must distribute a large share of their income to shareholders, and rising rents or property values over the long term can serve as a natural hedge against inflation. Financial Content Plus 2 EP Wealth Advisors Plus 2. Given today's economic environment where inflation remains a concern, interest rates fluctuate, and life expectancies keep rising, it's also wise to include inflation protected fixed income, things like treasury inflation, protected securities tips, short duration floating rate bonds. These help preserve your purchasing power and income stream even when prices climb. Invest plus one, but building thoughtfully is only half the job. A smart retiree remains engaged, periodically reviewing and rebalancing their portfolio so that it doesn't become lopsided, ensuring the mix of stability, income, growth, and liquidity remains aligned with changing needs, markets, and life circumstances. FB Financial Plus 2 Flat Fee Retirement Planner, COM Plus 2 in 2025, Safe and Smart Retirement Investments doesn't mean hiding from risk. It means embracing diversified, well-structured portfolios that guard against volatility and inflation, but still offer the chance to grow, adapt, and support a long, comfortable retirement. Because retirement isn't a sprint, it's a marathon, and your investment strategy should be resilient, flexible, and built for the long run. Imagine stepping into retirement and feeling a profound sense of calm, knowing that your savings are not just parked safely, but actively working to preserve and grow your wealth over decades. Security in retirement is no longer about hiding money under the mattress or settling for minimal interest in a savings account. True security comes from building a portfolio that balances stability, income, and growth in a way that adapts to the world around you. The first step toward this kind of financial peace is understanding that safety does not equal stagnation. While government bonds, high-quality fixed income, and certificates of deposit offer stability, relying solely on them exposes retirees to the silent threat of inflation. Over time, rising costs and longer lifespans can erode the purchasing power of even the safest savings. That's why a thoughtful mix of assets is crucial, one that maintains capital while providing opportunities for real growth. Diversification is the cornerstone of long-term security. Start with a foundation of stable, low-volatility assets, such as investment-grade bonds or inflation-protected securities. These instruments provide predictable returns and preserve capital, offering a buffer against market fluctuations. Layered on top of this foundation are income-generating equities companies with strong balance sheets, consistent cash flow, and a history of dividend growth. These companies often belong to essential sectors like healthcare, utilities, and consumer staples, providing both resilience and steady income even in uncertain economic times. Real assets and real estate exposure can further enhance security. Investing in real estate investment, trusts, or other tangible assets allows retirees to capture the benefits of property appreciation and rental income without the complications of direct property management. Over time, these assets often provide a natural hedge against inflation, protecting the real value of your portfolio. Liquidity also plays a critical role. Having a cash reserve for emergencies ensures that short-term needs don't force you to sell investments at inopportune times. This layer of readily accessible funds adds flexibility and reduces stress, allowing your core portfolio to grow without interruption. Retirement security is not a static goal but an ongoing process. Markets fluctuate, economic conditions shift, and personal circumstances change. Periodic portfolio review and rebalancing are essential to maintain your intended risk and return profile. Selling overweighted assets and reallocating into underweighted areas ensures that your investment strategy remains aligned with your long-term objectives. A disciplined, thoughtful approach allows retirees to enjoy income, stability, and growth simultaneously. By combining stable fixed income instruments, dividend-paying equities, real assets, and liquid reserves, you create a portfolio that adapts to changing conditions, shields against inflation, and generates income that can last decades. Ultimately, the best safe investments for long-term peace of mind are those that do more than preserve capital. They allow your money to grow quietly, provide steady income, and ensure that retirement is a chapter of financial freedom rather than anxiety. By embracing diversification, income generation, and adaptability, you transform retirement from a period of uncertainty into a time of empowerment, security, and confidence in the future. Picture this: you've spent decades building a lifetime of savings, and now retirement is here. The goal is clear: protect your wealth, generate steady income, and maintain your purchasing power for years to come. But in a world of volatile markets, inflation, and economic uncertainty, how do retirees truly invest safely without sacrificing growth? The answer lies in a strategy that blends stability, diversification, and adaptability, a portfolio designed to work for you, not against you. The first step in safeguarding your retirement is understanding that safe doesn't mean static. While it feels comfortable to park money in cash, certificates of deposit, or government bonds, these assets alone often fail to outpace inflation over decades. If your money merely sits there, it quietly loses value. Instead, the smarter approach is to combine stability with opportunities for growth and income. This means allocating a portion of your portfolio to low-risk fixed income instruments that preserve capital and provide predictable returns, while reserving part for assets that grow in value over time. Diversification is essential. A well-rounded portfolio should include multiple layers: high-quality bonds or treasury inflation, protected securities tips to safeguard principal, dividend, paying equities to generate ongoing income, and real assets such as real estate or rates to hedge against inflation. Dividend-paying companies, particularly those in essential industries like healthcare, utilities, and consumer staples, can provide steady cash flow and often increase payouts over time, adding a layer of resilience to your portfolio. Real assets, meanwhile, capture tangible value appreciation and provide a natural buffer against rising costs. Liquidity is another critical component. Maintaining a cash reserve for unexpected expenses or short-term market disruptions ensures that you aren't forced to sell long-term investments at inopportune moments. This safety net allows the rest of your portfolio to grow and compound over time without interruption, offering peace of mind and flexibility. Equally important is a disciplined approach to withdrawals and portfolio management. Many retirees follow structured strategies, whether it's a percentage-based withdrawal, a bucket approach dividing short, medium, and long term needs, or a combination of both. The key is aligning withdrawals with income-generating assets while keeping growth assets invested for the long term. Periodic rebalancing ensures that your portfolio maintains its intended risk profile, moving gains from overweighted areas into underperforming sections to preserve balance and stability. Longevity and inflation are often underestimated risks. Retirement can last 20, 30, or even 40 years, and costs inevitably rise. Investments that grow, produce income, and adapt to changing conditions protect purchasing power over decades. The ideal portfolio blends security with flexibility, allowing retirees to navigate economic shifts without sacrificing long-term objectives. Ultimately, safe investing in retirement is about more than avoiding losses. It's about building a sustainable framework that preserves capital, generates reliable income, and allows for growth that keeps pace with inflation. By thoughtfully combining fixed income, income-generating equities, real assets, and liquid reserves, retirees create a resilient and adaptive portfolio. This approach transforms retirement into a period of financial confidence, where wealth works quietly and effectively, enabling a life of comfort, security, and freedom.